The first thing everyone thinks when they hear about the stock market is that it's a risky business because you can lose money. Everyone heard stories about people losing their money in the stock market, and of course nobody likes to lose money. But actually, if you know a few simple rules, you can avoid losing money. So let's see what are the common mistakes people make and how you can avoid them. The first rule, don't panic. This is probably the most common ways of losing money in the stock market. Most of the time the market is going up, but there are times when there is a crash or a correction, when all the prices are falling because people are selling their stocks. In these situations, most of the people are not acting rationally. This is what we call panic selling. Last year, they introduced the virus in the news and there was a big panic on the stock market. The S&P 500 fell 34% from its top. So if you put money in the S&P 500 just before the panic and you sold your stocks on the bottom, you would lose 34% of your money. But if you didn't do anything, today your stock investments would be worth much more than before the panic. Not to mention, if you even bought stocks in the panic like I did, you would have much more capital gain on your investments. So there are times when these panic sales are happening and you only lose money if you sell in the panic. People who buy stocks in these situations earn the most. And sometimes there is not even a rational explanation for why the market is falling. In December 2018, the S&P 500 fell 15%. 2 months later, in February, the prices were the same as before. So what happened? Actually, nothing happened. Nobody knows why people were selling their stocks for a few weeks. The point is, the market is not always acting rationally, but you can only lose money if you sell your stocks cheaper in a panic. Another risky business you can do with stocks is if you buy companies that you don't know anything about. It's extremely risky if you buy a company just because it's famous or cool, or you read a lot about the company in the news. Just because a company has a cool product, or maybe it's a well-known brand, it doesn't mean that it's a good investment. If you buy a stock because of hype, you are not investing but gambling. If you don't want to pick individual stocks, then just buy the S&P 500 every month and forget it. This way you don't have to read the balance sheets of the companies. But if you invest in individual stocks, you need to know what's going on with the company. How much money they make? Is the revenue growing or going down? So let's say you have found a great company. The company is doing great, the revenue is growing, the dividend is growing, everything is fantastic, but how is the valuation? Valuation is extremely important. And we know that the market doesn't always act rationally. There are many companies that are overvalued and it's a huge risk buying these companies. You can minimize your return or even lose money if you buy a great company that is overvalued. This is one of the reasons people are losing money. They might buy great companies, but they buy them on high valuations. I always buy companies that are undervalued. This minimizes my risk and maximizes my return. For example, I bought Whirlpool last year when it was really undervalued. And now I have a 137% capital gain on it. Not to mention, I have a 5% dividend yield on my cost. The company was really undervalued, even though it's a great company. Another mistake you can make when you invest in stocks is if you don't diversify. Many people hear a story, for example, their neighbor earned money with Tesla and they put all their savings into the stock of one company. This is also very risky. They say that diversification is the only free lunch in investing. If you put all your money into one stock and that company goes down, all your money goes down. But if you have 30 different companies in your stock portfolio, you only have 3% of your money in one company. So if one company goes down, you only lose 3% of your money. And even the smartest, wealthiest people have a well-diversified stock portfolio. Bill Gates has a stock portfolio of 24 companies. Warren Buffett owns about 46 companies, and he even put his money in the S&P 500. So basically, he owns more than 500 companies. I talked about this in more detail in the previous video. If you are an investor who is looking for a dividend income, it's important to know how to avoid the dividend yield trap. A high dividend yield on a stock doesn't mean that nobody else noticed it. It means that something might be wrong with the company. Usually, companies with the highest dividend yields are the riskiest investments. Although there can be exceptions, but you really need to know what you are doing when you are buying companies with a high dividend yield. Usually, I avoid buying companies with higher than 5 or 6% dividend yield although sometimes I make exceptions and I have companies that have a dividend yield of 8 or 9%. Common sense would tell us that in order to make money with our investments, we need to be active and work hard. But this is far from the truth. In fact, Fidelity reviewed which investors had made the most money between 2003 and 2013. It turns out that the best investors are either dead or they forgot they have stock investments. So think about this for a moment. People who are the most inactive, either because they are dead or they forgot they have stocks, they have earned the most money in the stock market. This is because people are trying to predict the short-term movement of the prices, but it's proven that nobody can predict the price movements. And the more active the investors are, the more money they are losing. In fact, there is a saying that your stock portfolio is like a bar of soap. The more you touch it, the smaller it gets. Of course, if you pick individual stocks, then sure, you should take a look at how the company is doing on a yearly basis, but not on a daily basis. The press loves to write about the daily movement of the stock market, but this is because they have to write about something on a daily basis. This is how they make money. But following the market on a daily basis is completely useless. And selling and rebuying the stocks regularly is just a waste of time and a waste of money.